We're going to be talking about quite an interesting topic today. That's about going from a beginner to the big league. And if we put a ribbon around that as our first million in the stock market or in the investing side, what that actually looks like.
It's all about process. And the challenge we have as human beings is there may be a process, but we know best. And human nature can be quite a dangerous thing from a self-sabotage perspective.
Building key habits and mindset like an investor, because the thought process of being, let's just call it the average Joe bag of donuts, to becoming an investor is a huge shift in how you see the world.
It takes skill, because if you haven't taken the time to build the platform, the knowledge, you are going to find yourself really screwed up very quickly.
When you're an investor, you understand that time is your ally. And I know we'll talk about compounding returns later on. What would you say with respect to anyone? Because I think at the moment, with social media being as it is right now, we're constantly bombarded with showy wealth and Lamborghinis and get-rich-quick schemes and all that kind of jazz. It's not an overnight success story, right?
It's not.
If you invested $10,000 and you made a 10% return every year for 20 years, that money would be worth $67,000 to you in 20 years' time. What does that look like and how does that work?
That's the reward for getting started. The easiest decision to make is to do nothing. Passive. Hey guys, welcome to this week's Money and Investing Show. This week we are looking from beginner to the business end of this, becoming a titan in the market. It all starts in the same way, and that is getting the basics laid in and scaling. There's a lot we're covering in this particular live podcast. As always, make sure you take plenty of notes, but most importantly, make sure you take plenty of action. See you in the show. Hey guys, welcome to this week's Money Investing Show with me, your host, Andrew Baxter, and as always, my offside and co-host, Mitchell Olarenshaw, and one more. Some special guests today. We're live today in a room with 250 of our nearest and dearest clients. Good afternoon, guys. How are we doing?
Hey, don't we love it?
We're live, my man. Let's get on with it.
Who needs a segue when we've got that? Thank you very much. Cheers, guys. We're going to be talking about quite an interesting topic today. You mentioned we had a lot of comments on our socials and also a lot of questions in the room, which we've just gone through in our Q&A. That's about going from a beginner to the big league. And if we put a ribbon around that as our first million in the stock market or in the investing side, what that actually looks like. So we're going to break that down step by step for these guys live right now.
Gotcha. And I think this is a conversation I would love to have with everybody before they even click on a first trade. And the simple reason for that, Mitch, is that it's all about process. And the challenge we have as human beings is there may be a process, but we know best. And human nature can be quite a dangerous thing from a self-sabotage perspective. So, if you're someone that's coming in with a reasonable wad of cash behind you, and we've talked about big league, and the example we're using today, the metric is $1 million. We've had clients that are high net worth clients that have come in $2, $3, $4 million as a starting account to build from. And the challenge with that is that until you've built the muscle memory to deal with that quantum in the stock market, sometimes your account size can overshoot where your skill set and confidence is. But because you've been, certainly on a dollar basis, fairly successful in life to accumulate that kind of wealth, your ego is that, well, I'm at this level, so that's where I play all of the time. And to have to go back to ground zero and build something up from scratch, it's a lesson in humility, which is quite hard to cop on the chin sometimes, but it's probably one of the most important places to start from.
Totally. And then we also work with clients who are also coming from a point where they're literally at scratch and they're investing for the very first time, whether it be in the stock market or the property market or wherever else. So let's dive into that. You mentioned process. I think the number one point here for our audience and also anyone listening to this is building key habits and mindset like an investor, because the thought process of being, let's just call it the average Joe bag of donuts, to becoming an investor is a huge shift in how you see the world.
Look, it takes skill, because most people are familiar with property. Most people own a property or they're familiar with the property market, which is a very slow moving and very passive beast. Whereas if you're looking at investing directly in markets, whether that be the stock market or if it's crypto or Forex or any of the other exotica that's really out there, they're faster moving, but perhaps more importantly, there's a real-time scorecard which has been custom designed to screw with your head. So when you turn on your trading screen every day and you can see whether you're up or down a few $100, a few $1,000, a few $100,000, depending on your account size, that's got the ability to really impact on how your decision-making is, what you do, how you do it. Whereas as a real estate investor, it's highly unlikely as you're walking down the street, you look at your house and go, okay, that's just jumped up by $3,000 today. And so that's your watermark. You don't think about real estate in the same way. So the skill set for direct market investing most certainly is different, because the feedback, the biometric feedback, the value of your account is right in your face. And I think more than anything, if you haven't taken the time to build the platform, the knowledge, and we'll get on, I'm sure, and talk about how important education is within all of this. If you haven't taken the time to do that, you are going to find yourself really screwed up very quickly, because trading will highlight any and all of your personality defects quicker than anything on the planet.
Oh, totally.
Yep.
And I think we dive later on into mindset and psychology as a specific topic, because I know that's something that a lot of our newer clients certainly struggle with. One word you mentioned over and over again, though, was skill set. And I think that's an important distinction to make, is that investing is not about guessing. No. You need to do your due diligence, you need to do your research, because ultimately it is a skill.
Yeah. Look, it entertains me to an extent, especially on a Friday night, which is when most of the trolling happens on social media. People sit at home, they've had a few drinks, realise life's not going where they want, so who can I lash out at? And it's just gambling, or all of these different things. And there's always uncertainty with any kind of investing. And the goal of becoming educated, particularly with the processes that we apply for our clients, these guys in the room and beyond, is about getting the balance of probability up. You're never going to always be right. But if you can take steps to avoid treading on a lot of the obvious landmines that start to move your probability of success from black or red and gambling, 50-50, to maybe 60-40 or 70-30 or 80-20, even with those ratios of win-loss, if you've learned, A, how to nudge your success rate up, and B, if you've learned how to manage risk, you're on track for a very fruitful and successful financial future. So it's not gambling, it's about, I guess, having a high level of confidence or certainty and a balance of probability that's swinging in your favor. And I think that's more than anything why I think cash flow on demand, which, as we all know, is our flagship strategy, is one where the odds are really stacked, I'd say almost unfairly, in the client's favor, which is as it should be. That's the reward for taking the time to get educated.
Yeah, it's a huge distinction for sure. And I think probably the hardest part to overcome out of all of that, which is learning a new skill and implementing it, is understanding the notion of time. When you're an investor, you understand that time is your ally. And I know we'll talk about compounding returns later on. What would you say with respect to anyone? Because I think, at the moment, with social media being as it is right now, we're constantly bombarded with showy wealth and Lamborghinis and get-rich-quick schemes and all that kind of jazz. Yet investing property or stocks or doing cash flow on demand, it's not an overnight success story, right?
It's not, and I think the salacious nature of marketing like that is one thing that the regulator ASIC really don't like, and for good reason, because I guess if you're squeezing that greed gland for people and appealing to an emotional sense, their motivation for wanting to get into this space is not really wholesome or true, if I can use that term. It's allured in by shiny objects, and the reality is, I mentioned earlier, investing is all about a process, and money you make is just a side effect. It's not the goal in it.
I like that. That's a good one.
It just is a very nice side effect.
Yeah.
It's rather like, keeping bees. I keep bees on my farm, and everyone's going, oh, that's great for the honey. And the reality is, keeping bees has got nothing to do with the honey. It's got everything to do with making sure your crops are pollinated, and you've got a really healthy ecosystem, and there's no chemicals around. And your reward for that stewardship at the end of the year is some beautiful honey.
It's funny, someone said this to me the other day. They said, why do you run for such long distances every single week of your life? I said, well, I'm actually just people watching and looking outside. It's happened to be running at the same time. Yeah. I think they thought I was crazy, but similar kind of thing, right?
It is. It's a serendipity of it. And that's a very, very hard point to get through, because the flip side of that is we're in a hard-nosed business, a money business, where it's all about the scorecard. It's all about getting the account to build. But if that's your primary focus, it's the wrong thing. And the reason for that, it's a goal that you don't ultimately have total control over. The thing you can control is what action steps you're taking, what you're doing consistently, regularly, in terms of building your knowledge and education, building your confidence in the process that you've developed, improving your self-discipline to just buy into that process and not get blown off course because you got out of bed the wrong side that morning, and just having the discipline to consistently do that. And the worst of it is you can do all of those things right and still not necessarily make money, which is a real test as to what your motivation is all about. What's your real why for this? Second to that is that you can do all of that work and you don't get to see anything initially. You might see a little nudge in your account, but it's in 2, 3, 5, 10, 20, 30 years where you really see the reward for that decision that you made that day, just that compounded. And that's the hard thing, because we live in a world today which is bombarded by massive biometric feedback. Right or wrong, you put a post on social media, you get likes, or not, as the case may be, or followers, or comments, or retweets, or whatever it may be on the platform that you're on. And we've become a society that thrives on that immediate gratification of a reward, as opposed to learning the patience and discipline that perhaps I sound like an old man when I say this, but our forefathers had, where you just got your head down and let time do its thing for you. And we don't seem to appreciate that so much these days.
Yeah, I think controlling your emotions to have that consistent contribution is the main thing. Understanding time is your ally, but you need to be constantly topping that up, budgeting rather, saving then to invest. Talking about moving this forward, now that we've got a bit of a grip on the mindsets that's required to become an investor, for our audience out here, and I'd like to engage these guys in a moment's time, sometimes what to do is doing the opposite of what not to do. And I think controlling and avoiding some of the common early investing mistakes is really important. So one that probably springs to my mind as an early mistake is the hot tip. Someone rings you over the phone, I've got this hot tip, buddy, you better buy in.
Yeah, look.
Has anyone ever had that happen to them, just out of interest, show of hands?
It can be a real misnomer, and a lot of people, when they start on their investing journey, they've got a family member, buddy at work, friend that's involved with the markets, and the challenge with that is twofold. Number one, they're only going to tell you about their success. Oh yeah, I'm in the market. Oh good. Oh great. They're not going to say, oh, I'm in the market and it's really terrible. So you're going to get a very skewed perspective of how it's going. And second to that, what they're doing may not suit you and your financial DNA, I suppose is the word for it. So, you might have someone that's doing stuff that's way too racy for your personality type. But because they're doing it and it's working, the sort of, not the peer pressure, but the inertia, the proof is there, oh, they're doing it, it's working for them, I should do the same before I get left behind. Only to find yourself having sleepless nights as you're riding the volatility train through whatever market it is, or worse still, on the other side of the coin, it's way too pedestrian for you, and you go, this isn't working for me, and you bail out, and that was the stock market. It didn't do anything for me. I'll leave it alone, find something else.
It's funny, I had this exact thing happen to me probably 2 weeks ago. So I had a family member, I'll spare their name, ring me and say, hey, someone's just given me this tip on this stock code. Can you have a look at it for me? And I probably get 5 calls a week of that kind of nature from someone, a friend or a family member. So I took a look and I said, yeah, this stock's gone from 20 cents up to $1.20. And they said, yeah, this person's made all this money, I want to buy in. And I said, well, bear in mind the stock's already up a couple of 100%. You probably missed the boat. Yep. There was such a strong level of FOMO there. If I've got this hot tip, it's gone up, I need to be in. Yep. That stock currently is now dropped 40% and is halted trading, just for some perspective. So
yeah, you get the tip when it's time for the other person to get out, because they've got to create a market to sell to. And social media has been brilliant for that, insofar as you can cascade information across millions of people about something on an unregulated and unauthorized way, I suppose, to say, oh yeah, this has done that, and all of a sudden the buyers are lined up to help take you out at $1.20, and you cash out and you've got your dough, and they don't. You have to be quite tough not to fall into that whole thing, because everyone wants to make money. And if there's an easier path to take, there are lifters and leaners in life. We're just talking about this at lunchtime. There are lifters and leaners, and sometimes you've got to be a lifter. You can't just lean on. You've got to do the hard work to get there, and you've got to do it, consistently. And those small contributions, even when it doesn't feel right to do. And one of the things, and we'll get on to sort of time value of money and time slicing your entries and so on in a moment, but that notion of buying when it doesn't feel right is actually what you have to do, because if you're making decisions based on how you feel, you're screwed. It's what everyone else does, which is why everyone is broke.
Totally.
And you think, oh, that's a bit of a harsh statement to make, but what percentage of the Australian population have got less than $3,000 in the bank? And it's a
40% or so, I think.
Staggering number. So why would you want to do what everyone does if that's the benchmark? So that ability to independently make a decision, even when it feels challenging, you got to put the feeling aside and just go, I'm in.
So question for you, this podcast is about going from beginner to big league. So let's make the assumption a beginner, you may not be working with a huge slab of cash. It might be a smaller amount, whatever you've got to work with. I think a common mistake that the beginner makes is either over-diversifying or under-diversifying, which arguably are both just as risky as one another. What would you say to anyone in that camp who's got cash to invest?
Look, it's very true. A lot of people have heard of diversification, not having all your eggs in one basket. And the challenge, sometimes when we meet new people that come through the ecosystem, you got someone that's starting with 100 grand. They say, okay, I've got 100 grand to start with, and that's relatively easy to work with because you can look 5 positions at 20 grand is probably an okay sort of spread. If you've got someone that's walking in the door with 10 grand, you can't tell them to have 5 positions of $2,000 for the simple reason that, number one, the strategy we use requires you to buy parcels of shares in blocks of 100. But secondly, it's such a small position size, and that's not to be critical or besmirch someone that's coming in small. We all start small. I started with nothing, and then a little bit, and then a little bit more, and then I lost it all and had to go again.
Me too.
And the fact that you get up off the canvas and go again, I think is pivotal in terms of your mindset. So someone that's coming in the door with 10 grand, you say, look, at the most, you're probably going to have 2 positions of 5 grand each, and that's really going to be it from a diversification point of view. Is a difficult conversation because that's a very committed position for someone that's only got $10,000. Half of their money is in on one trade, and so to try and tamper that concern down, I think this is where ETFs in particular, an ETF as an exchange-traded fund, have been a great way for new people that are starting with smaller accounts to come in and buy a bag of the NASDAQ where they can have 5 grand, or even if you're coming in with 10 grand, have 10 grand on that, and it's not one trade because it's holding 100 different stocks. And you've got the natural benefit of that diversification, but in one trade, making sure that your transaction fees don't blow out and all of those different sort of headwinds that can happen with smaller accounts. But you've got to get in, and I can tell you now, the hardest trade you'll ever do is your first one.
Oh, yeah. What was your first trade like, out of interest? I think I know the story, but for the benefit of our audience today.
My first trade was just before the 87 crash, without giving my age away. So I can hear everyone doing the maths in the background now, tapping away.
70, 80.
Yeah, so back in the 1500s, yeah. And so I got in, I think it was around about probably August, September, and I finished working the school holidays and I had this cash, and I'd got an account set up through a family member, and yeah, I got dusted in October. It was broken glass everywhere. So my recovery trade, I had about 5 grand, and I was earning £1 an hour. So it took me a lot of hours to save that up. I had a couple of good sidelines too, I might add, but I had about 5 grand saved up, and that trade was on a company called Abbey National, which was a UK building society that I bought shares in as a demutualized, and the share price went through the roof.
Nice.
And that was great.
Mine was much
paid my way through uni with that. It's a good trade.
Very nice. Mine was much the same. I used to admittedly be quite a bad spender when I was young. So my philosophy back then is any money I earned that I didn't need to spend right then, I would take it out of the bank in cash and I would stick it in a shoebox.
You still don't like spending now. You are so tight. You are as tight as a fish's bum.
The apple doesn't fall too far from the tree, right? You wouldn't spend Christmas, I know you. So I used to stick all this cash in a shoebox so that I wouldn't spend it, and I would hide the shoebox intentionally. And then once it built up, I think it was 5 grand or something like that, I took out the cash, put it in the bank, put it in my trading account, and got the first trade on that I could find so I wouldn't spend it. And I subsequently pretty much lost the whole thing. Yeah. So that was a bit of a moment of realization that
this is really
a little
impressive.
bit tougher.
So for all these people listening and our audience, the thousands on the podcast that listen to this, so your 2 mentors that are sitting here basically did their ass on their first trades. That's pretty impressive.
Yeah, and completely did my ass.
And I think that's important because success, if it comes too easily, is something you can very easily take for granted. And if you've had to work your way back from that sort of thing and dealt with a setback, I think it shows a few things. One is resilience, which is without question, I think after time, resilience is probably the next attribute you need to be a successful investor. But more important than that, you want it. And that desire, that reason why will help you overcome any obstacle. And I was in tears, I genuinely was, after my first venture and dusting my cash. And it really hurt. And I thought, this is not the end of my story. I just had this no, I am going to be successful. And you got to get up off the canvas and have another go. And the worst of it is that if you don't have the right support network around, and this is a beautiful thing, I guess, with the ecosystem that we've provided and continue to through Australian Investment Education, is that you've got a supportive ecosystem, whereas outside in life, if you choose to step up and say, hey, I'm making a decision to financially better myself, and this is especially true, we don't have this problem in the US when we talk to our US clients, but here in Australia, that tall poppy syndrome, people cannot wait to shoot you down. And if the wheels come off, they're all, ha, told you, and kind of rub it in. And it's a very toxic kind of environment. So being able to find a different peer group, a sort of mastermind of people that are all on the same pathway, I think is hugely important, but it's really hard to find.
Totally. And, I think back to my first trade, as I'm sure you do as well. I know where I went wrong is I didn't have any risk management, which is, my next topic of conversation here.
I didn't have live data because I was getting my prices out of the newspaper because there's no internet then, but that's...
So 1500s, you probably are right there. Risk management was a big one for me personally. I didn't have any of it and subsequently lost all the dough that I'd saved up. I think that's a common mistake for a lot of beginners is they don't know what they don't know. And if it's your first time having your first crack at something, it's kind of one of those things that just floats away as I'll get round to it. How important would you say risk management is even for a beginner with a small amount of money?
It's non-negotiable. It's easy to throw terms out like non-negotiable, which is a very strong phrase. It doesn't matter how much money you make, it's what you get to keep, ultimately. And risk management is designed to retain that money in your account. And it doesn't sound fun, and it's not. And whenever you take a loss on a trade, psychologically, you go, ouch, or not, as the case may be. And we got to a mindset place whereby if you ever hit a stop loss, everyone does a lap of honor, and they're cheering and carrying on. This is true. And you go, yeah. And you go, well, how can we be celebrating hitting a loss? And you're not celebrating the dollar move. You're celebrating the fact that you're adhering to your process.
You did exactly what you were supposed to do.
And it's trying to condition you to stop thinking about the scorecard, which is going to happen anyway, and focus on the thing that you've got the control over, which is how you manage those positions. And invariably, the first cut is always the cheapest. And to really put some meat on that statement, you can't make a big loss in the stock market, said the licensed professional sitting here, without making a small loss first. It was small, but because of your inaction or ego or lack of experience or lack of trust in a process, you thought, I'll give it another day. And I'll have a think about that when you're listening.
Or the one more day.
I'll just give it another day, see how it feels, see what goes on. And the next day it's worse news again. And you go, well, now it's fallen too much. I'm not going to realize that loss. I'll just hold on now. And then it drops another 10, 15%. And now you can't afford to. You end up this thing in your bottom drawer for the next 200 years trying to wait for it to come back.
That was my second trade through COVID. So not only was my first trade a loser, I think my first three were.
Two-time loser, well done.
Yeah. 3-time lucky. 4th time turned it around. And I think it's important to note as well, aside from risk management, is having a time horizon and some goals around that. You mentioned adhering to the process, having risk management are two mistakes that people often make. I think not knowing what you want or what you're wanting to get out of it is important as well. What would you say to anyone who's unsure about what they want?
Look, if you don't have a reason why, you're screwed. It's like any road will take you nowhere. You've got to know what the destination looks like. And so when it comes down to building a trading plan or a business plan for that matter, most businesses fail. 85, 90% of businesses fail because they don't have a plan. And trading is exactly the same. People go, I'll go in, I'll get in, give it a go, see what happens. And it's absolutely unfathomable that you can think that's a smart thing to do because, you wouldn't run onto the field to play at the Gabba and try and play a game of AFL unless you knew what the rules were because you're going to get absolutely thumped. You're not going to know what to do. You'll be giving away penalties. You'll be on the losing team. Yet when it comes to the stock market, people think, I'll just put some money in an account and abracadabra, there she goes, and off it runs. And it's not as simple as that. And I think almost the worst thing, we've both mentioned that we had losing trades initially. Almost the worst thing that can happen for someone in a beginning phase of their learning journey is to have a great win straight off the bat. And that's really hard to sit here as a coach and mentor to thousands of people and say, we almost hope you have a losing trade. I know that sounds a terrible thing to say.
He's poor audience.
And they're going to get stoned in a moment. They'll be throwing things at us. But the reality is what that does, it really wakes you up to the danger that's out there versus becoming a little bit complacent and almost cavalier in your decision making. And I know that sounds a really tough thing to say, but that's what coaches do. They tell you the tough things. Coaches win games, cheerleaders don't. You want a hug, go down the road. You want a coach who's going to help you make money. Take this sort of stuff on board and understand that there's always going to be an inherent risk. And people, I think, are hardwired to want to test rules, in every way, shape, or form, because deep down inside, all of us have got maybe a slightly rebellious streak. Nearly everybody does. And if you've got a thing that you've been told not to do, the first thing you want to do is work out why you were told not to do it. And
That's the apple on the apple tree, right?
It is. If you go back, to early times and think of the story of Adam and Eve, there's only one rule in the Garden of Eden: don't eat the apple, and we couldn't even get that right. And you're putting people in front of a market saying, don't do this and don't do that. Well, why not? I'll try it and see, and you get a bad taste, and then you maybe walk away. So I think learning how to disconnect yourself from, firstly, the dollar value of your account so that you can be unemotional in your decision making. Secondly, be extremely self-disciplined as to what the process is that you're trying to do. And thirdly, invest in learning what that process actually is, the mechanics of it, things like technical analysis, fundamentals, quants, support resistance, basic stuff, and we'll go on and talk about how that can really work for you on a grand scale. But people overlook, I'll just get in and I'll work it out you don't want to be approaching investing like that.
Totally. And if we view this journey from beginner to big league, as we start to now get into the nitty-gritty, understanding your mindset, avoiding mistakes, then the next step is getting that money working for you. So here's some stats for you. If you invested $10,000 and you made a 10% return every year for 20 years, that money would be worth $67,000 to you in 20 years' time. That's with a very small starting balance at 10 grand. And that's just at a 10% annual return.
Okay.
What does that look like, and how does that work?
That's the reward for getting started. The easiest thing to do in life the easiest decision to make is to do nothing. It's passive. I'll get round to it. It's not the right time. We've just had that bill, the cat's got diarrhea, whatever it is that's going on in your life that prevents you from making decisions, and it's easier just to do nothing than put yourself out of your comfort zone to try something different and try something new. And that reward, that compounding, is almost the opposite of it, is the drift. So if you don't do anything, not only do you miss out on the return that other person has made, but you're getting left further and further behind as their knowledge skill grows and they take more action and scale up, and you're still doing the same old. You end up not just 50, 60 grand worse off, but it can be worth much, much more than that. If we have a bit of a maths off for a minute.
You're going to beat me at this, you know that, right?
I'm backing myself on that.
Yeah.
I'm backing that.
Don't screw it up now.
No, pressure, hey. 30 grand, let's say you got 30 grand saved up, and you've made the conscious decision to put it into a managed fund or put it into a trading account with us. And if you look at the cost of underperformance, so if you take managed funds as an example of this, which is a very passive way, it's a $1 trillion industry, multi-trillion-dollar industry in Australia. So on average, according to the latest research, the research I'll quote is from Standard & Poor's, so it's Fed income research, it's really
That's reputable,
industry,
for sure.
Industry type research. So according to their favour report, which they do each year, so the latest report for 2024 shows that 85% of managed funds, equity general funds, managed funds in Australia that invest in the equity market, 85% of them underperform their benchmark over a 15-year time frame.
The benchmark being the ASX 200,
ASX
right?
200, or if they've got a different benchmark, they typically underperform. And that's not over a 5-minute window, or they had a good or bad year, so we're trying to curve fit here. That's over a slab of 15 years worth of data. Now, when you look at how much that money underperforms by, on average, the median return from a managed fund under the benchmark is about 2.5%.
So they're missing out on 2.5% on average.
Which you think, okay, if your fund's growing at 6.5, 7, and the market's growing by 9, 9.5, you're still making money.
You're not missing out on too much, right?
Not missing much, right? But that actually is a really misleading way to look at it, and this is why I guess a notion of financial education, teaching people how to get control and apply a strategy that typically outperforms the market, is so important, so you're not falling foul of this. So let's get to the math off. So if 30 grand invested over a 10-year time frame, if you underperform by about 2.5% over a 10-year time frame, that's worth about 20 grand on a $30,000 account.
Okay.
Over 20 years, that number blows out to about $81,000. Over 30 years, that's $246,000 of underperformance. And you're only talking about 2.5% a year compounded over 30 years, and that's the different trajectory that you can go on.
That's a difference in retirement of living a really good life and a not so good life.
It is, but that's someone that's already started investing. Now imagine you didn't get to square one, which is putting it into a fund that, albeit underperforms the market, you've just held back in cash and hoped that things are going to work. I mean, the difference is infinite. So it's about definitely getting started. And to go back to your point on risk management, why it's so important, if you took someone off the street and said, I need you to climb up this tree and pick the apples off it, and they start to go out on a limb, maybe it's a little bit windy out there, it's not going to be a particularly fun experience, and you're not going to get, we should probably try this, we'll get our camera crew out and we'll see how we go, filming it somewhere. But if you put a safety net there, or a crash mat of some sort. And when you fell out of the tree, you landed on a crash mat. Most people go, well, okay, like the damage I can do is minimal. It's worth it to pick some apples. That's what risk management is. You have to climb the tree. You have to go pick the fruit. And it's about, you've made that decision. We all know we need to do that. But how can we do it in a way that's safe? And if you really don't like risk, well, there are other things that we can do that put a harness on, a helmet, a crash mat, pads, maybe somebody underneath to try and catch you as well. Who knows? But there are layers of risk management that you can put there. But without them, well, you're playing with fire. And if it goes wrong, it can be catastrophic.
Yeah, there's probably three things that really stick out to me to go from beginner to big league. It's probably time, consistency, and reinvestment. To look at everything that we've spoken of today, you need to spend the time, you need to consistently reinvest your funds, and you need to protect that capital.
Look, they're all valid points, and I think, again, that needle doesn't move fast initially, and if you don't compound your returns, if you don't reinvest, so with cash flow on demand, you've got your income that comes from selling your option, you go, that's my income to spend. If you're in a retired situation whereby you're a self-funded retiree, that could be you're spending money out of your super. I understand there's a drawdown factor to that, but if you're still at the growth phase and you're building, the worst thing you can do is pull that money out. The best thing you can do once the machine is running for you and you're happy with the kind of returns where you're getting, is to make sure you leave that in there so the whole thing swells, the flywheel's spinning faster, and the cash flow number becomes bigger. For 3-5 years, if you can, longer if you can do that, because the bigger you get that asset base to grow over a period of time, the cash flow that it'll spin out to you later on is significantly bigger again. And to that point, also regular contributions. If you've got spare cash, and we just
get it in.
Get it in. And people say, I've got an offset account, or I could repay my mortgage more quickly. And look, there's merit to that too. I understand that, and it's tax effective to do that. Don't repay your mortgage, use the offset account, because if you need the cash, you can pull it back out. Whereas if you repay your mortgage, you can't. But if you save, with interest rates falling, if you're saving yourself 5% a year interest by having an offset account, but you're missing out on 10, 12, 15% on the other side of the ledger, you're way better off getting that money invested and working for you. So they're decisions you have to make. And I'd also say, if you've spare cash, regularly keep contributing to it. So that time slicing of money going in, it takes away an ego component to this, if I can say that. And that is that after a period of time, if you've done the work and you're getting better at timing the market, you're going to be more selective as to when you hit the go button. At the same time, you can also be waiting for the perfect storm to invest as well. So one of the things that I do for one of my family accounts, I've got a family account, it's our birthday account. And I have a lot of birthdays in my house, with 6 children, my wife and I, there's 8.
In-laws, nanny, chef,
it's
like
a
15
10-ring
birthdays.
circus. I mean, there's a cast of thousands.
I'd hate to see your cake bill at the Cheesecake Factory.
Yeah, it adds up. And I think one of the things I religiously do is to always, on a birthday, forget about what the market is doing, buy an allocation of stock.
Great
on
idea.
that birthday, a dollar amount, and they're a set dollar amount. My wife and I is X, my elder kids it's Y, and for the youngsters, like my eldest is 10 at the moment, and my goal will be, by the time my eldest is 18, that account will be.
So pure investment strategy, long term, birthday money in, no timing involved, just bang bang. I do the same thing every time I get paid. I put X amount of dollars over to an investment account and onto the mortgage. That's my rule. Same amount every single month. Every single day.
And you can try and time the market, which if you can is great, but if you try too hard to time the market, you'll talk yourself out, go, it looks really toppy right now, I'll wait. And then 2 weeks later, it's up another 5 or 6%, which you've missed by trying to introduce a bit of fancy footwork. And I'm not going to say that flies in the face of the education that we provide, because the idea of, how can you put it, the idea of learning to upskill is to be better with your timing. But if you've got multiple different accounts, maybe you've got a family trust, a super, and another account, personal account, having different strategies within them or different approaches gives you a great form of diversification, which from a risk management point of view, I think is pure gold. Now, when you're starting out, that's going to be quite challenging, but maybe when you're starting out and maybe when people say, what do you want for Christmas or your birthday or whatever, you say, look, if you're going to give me cash, I'd rather it just went straight into my trading account.
100%.
And I can start to build that up. Oh, what do you mean trading account? You'll end up referring to us and get commission as an affiliate of ours.
So last segment before we get into our Q&A, AB, is the notion of goal setting. So I think this has given us a really good framework around seeing things as an investor, avoiding mistakes, and then understanding the notion of compounding returns or the time value of money. We then get into goal setting. So you've saved up some cash, you've had enough discipline to budget and save, you need to then invest. Yep. You're reinvesting, you're following the process. How do you then set goals? And I'll break it down: habit, identity, achievement goals, short, medium, long term. Sorry to put you on the spot.
Well, I think everything in life comes down to one thing, and they're your habits. Yeah, and that's a big blanket statement to make. You know, if you're overweight, it's not because of metabolism, it's probably because you've got a knife, fork, and spoon habit. Simple as that. If your credit card bill is ratcheting up, it's because you've got a bad budget habit. So the habits make everything else. They're the most foundational level, but they're the hardest place to really challenge people, because if you walked up to someone and said, what you're doing is wrong, that's probably not the best way of building rapport.
Yeah, I wouldn't recommend that.
And there's always going to be a resistance because no one wants to be told that they're wrong. But then you've also got to have that introspection where you look at, say, okay, where am I in life? Am I where I want to be? And if I'm not, why is that? And the reason anyone and everyone is wherever they are in life is a compounded effect of the decisions and habits that they've built to that point in their life. So
a couple of examples of, say, a habit goal for an investor to really scale. Let's say you want to save X dollars a month, and out of that X dollars a month that you save, Y amount of dollars goes into your trading account. You then do X, Y, Z as a part of your trading plan. That's very general, of course, because everyone's going to be different on amounts and what they're doing. But they're habit goals, which ultimately will lead you to an achievement goal, which is to make X amount of dollars or to spend this amount of time in the market, for example.
Well, the achievement goals will flow out of that, and yet if you go to a traditional sort of goal-setting workshop, we run one of these every January. You know, it's sort of winning the game, get yourself kick-started for the new year. And when you ask people to set goals, typically the process they'll go through is usually stuff or things. So one of my goals this year is to go to Europe, or one of my goals this year is to get a new car, or one of my goals is to have my credit card paid off. Or
they're all three of my goals, you know.
Well, you got all those covered anyway, so I mean,
I'm off in 2 weeks.
There we go. Looking forward to it.
Yeah.
I've got a challenge for you. I usually, when I go to Italy, I try and budget for about 2 kilos a week in terms of weight gain. So I'll be really interested to see how you go. Don't underperform, okay?
2 kilos of limoncello, I think, for me.
Yeah, I think your discipline might be a wee bit better. But, you know, those sorts of things typically, just to give you an example of some things that people might be pitching at. And I think all of those things are really a byproduct of building good habits, and those good habits might be I've become less frivolous with my spending, and that's not to become the fun police. I like spending as much as the next person, but I think if you spend money and it always comes out of the profits from your investment, your capital is continuing to grow, and you've earned the right for that. You've put a qualification on your spend rather than just going, I'll have it.
Totally.
Because, you know, if you get yourself in a financial position where you can have stuff without really thinking about it too hard, I think you lose your edge. You become really soft and bloated. Your decision making becomes clouded, and typically you're riding for a fall. So I think building that discipline and habit in there is really crucial. So it might be I'm a person that is able to budget and have spare cash flow, and my follow through action, my achievement goal is when I have spare cash, not I'm going to have a car, watch, holiday, whatever the thing might be. When I have spare cash, just as an example, I'm not suggesting this is advice, you know, I take that spare cash and I buy another slab of TQQQ, for example, or whatever the investment asset may be. That's the achievement goal, is to have the habit to create the cash, and the action is that. And then when you look at, for example, a money and investing journal, at the bottom it said, right, when you've achieved this goal, what's your reward? Not the reward itself, that's the byproduct, if that makes sense.
Rewards aren't really my strong suit.
I'm terrible at it too.
Last thing, we're going to do a Q&A.
I think before we do that, we've got to go to identity goals. And that's
absolutely, sorry, my bad, correct.
And there you go, we're live, right, aren't we?
We are live. This is the real podcast.
So we've talked about habit goals to build the behavior. Achievement is the thing that flobs out of that by default. When the process is right, the results follow. I think identity goals are huge, and they're probably the hardest one to crack. And, you know, there are people in the room I've worked with, you know, quite well on this, yourself included, whereby you've built the habits and the achievements that sit behind it, and what it does, it creates an identity for you. And one of the ones I run into out and about in the field from time to time is we have people that go, look, we're just not good with money. which is an awful story to tell yourself, because guess what? If you keep telling yourself that story, you're going to be right.
Oh, yeah.
That's one thing in life you don't want to be right about, is being bad with money. And instead, taking on board to be a different identity goal. Look, historically, my family haven't been good with money, but I'm going to be the person that breaks that chain and creates a new ending to that story, is a really strong setup for you to be able to dig deep. And we started the interview and the podcast off with, you've got to have a strong reason why. And I think identity goals particularly give you a reason why. I'm a person that this is how I am, this is what I do, this is how I live my life. And if all your decisions are aligned with what your values are as an identity, they're very, very hard to shake. If something really shiny comes along that you want, but you've got an identity goal that I'm great at managing money, and part of the serendipity of that is I can have lots of things, but I only get those things out of the proceeds of my investing. What you've done is set up a machine that's so stacked in your favor for long-term financial success, and there's no loss of gratification because you can have anything you want anyway, but you've taken a little bit longer to get there, and you've done it in a way that's totally sustained on your terms. And I think the sense of well-being as a human being you get from really being clear and stepping out of your comfort zone and saying, this is my time, this is who I am or who I'm becoming, not who I'm going to become, because that never happens. Coulda, woulda, shoulda. Who I'm becoming, it's already underway. You're even listening to this podcast, it's already underway. That's something I think when you look at yourself in the mirror in the morning, you know where you're going, what you're doing, and you can be very proud.
That's right.
What life is all about.
Then your identity is you're an investor and you're already in the big league or on your way to it.
Yeah. And look, it opens the door for a whole lot of stuff, whether that's providing for your family, whether that's indulging in hobbies that you might have, whether it moves into some of the weightier and more meaningful areas of life like contribution, which are hugely important too. That all starts with one simple thing, and that's a decision that you've made to build good habits, to become an achiever that's got an identity of success. Starts at ground zero.
Nicely said. Now, we've only got a short time left, AB, so we're going to jump into our Q&A. We've asked our audience in the break here, over 200 of them, for their questions, and we've singled out just five of the best questions. So we're going to announce the person who asked their question, and then we're going to get that particular candidate to read their question to the group at large with the microphone. So, girls, if we could stand at the ready, and then we'll do our very level best to answer the questions. You ready to rock?
Let's do it.
On the spot, no practice.
What do we got?
Okay, so Jeff W, if you wouldn't mind standing up for us right now. Here he is down here. So we'll get the microphone run down. Thank you, Jeff. Give him a round of applause. Just in case you need a refresher, there's your question. If you wouldn't mind speaking directly into the microphone nice and loud, and let's hear it.
Good afternoon, everyone. My question was, how do you find stocks worth looking at?
Great question. How do you find stocks worth looking at, AB? I think to turn that question on its head, it's very easy to find stocks that you don't want to look at. And some simple forms of analysis can really assist with that. So number one is going with stuff that's trending in the right way. So you want stocks that are moving in an upwards or starting to move in an upwards trajectory. It's not about getting in at the ding-dong low, it's just coattailing the momentum that's in the market in the first instance. Part of that is reading the chart, which obviously is something that we teach and we've spoken of already today. Add around that some of the fundamentals and news flow that are also supportive and driving that direction of the stock. And that's starting to give you a bucket to pick from, and it's also giving you a very large bucket to stay away from. Once you've got that bucket to pick from, finding stocks or businesses that resonate with you, your personal values, your interest level, or where your confidence on that particular industry or sector sits probably helps you screen that out. Personally, I have a very small universe of stocks that I trade. If you look at my trading patterns over the last probably 7 or 8 years, it's within QE probably the same 8, 9 stocks over and over and over again. Sometimes I'm in, sometimes I'm out of them, then I'm back in, then I'm out of them, and so on. And it means I can learn a lot about a fewer things and have a high level of confidence with those stocks to hit the go button and reap the reward from it.
Give me a round of applause, guys. Thank you, Jeff. Okay, we're going to keep this rapid fire. So Blake, is Blake in the room? If you could please stand up. Can the real Slim Shady please stand up? Thank you, Blake, right at the end of the room. We're just going to grab the microphone there. This part will be edited out, guys. This awkward silence, don't stress. So if you need to cough or have a sip of water, you can now. Okay, let's hear it, Blake. Our question for you, my friend.
How does earnings reports influence your decision to trade a specific instrument?
Oh, I like that one. Earnings are really interesting, Blake. Of course, you're going to see an uptick in volatility around earnings, naturally, of course, because the earnings themselves are uncertain. The definition of risk really is the level of uncertainty. One thing we can often see is stocks can often get a tailwind into their earnings results. And that's as the market probably grows a little bit optimistic about what those results will be. That comes with a level of due diligence and research, because there's, I guess, levels of patterns that we find with stocks, which on average, and you can literally look at the research back on this, out of the last 16 earnings reports, in 2 weeks leading up to it, it's gone higher 80% of the time, for example. And modeling that it sounds like an arduous task on the surface. It's really not that hard to be able to break it down. Golden rule of thumb, of course, with cash flow on demand, we very rarely ever hold stocks over earnings, given that nature of uncertainty. One thing you could look at is buying puts to protect yourselves over the earnings date in order to insure your shares effectively if you still want to hold it. Otherwise, I guess probably my favorite strategy of all time would be that of the straddle, which anyone within our more advanced option style of trading would be familiar with. So in short, Blake, it's not necessarily a scary thing as long as you know what the plan of attack in and out is and around that. It's telegraphed, it's information you know about. So building a plan around that's really important.
I think, that's it in a nutshell. To add some value to, when companies report, they're required to share their P&L, the numbers, the figures, balance sheet, and obviously their curated explanation of what those numbers look like. And I remember really, really early days in my career, and it stuck with me as a phrase, and feel free to take it if it works for you or kick it into touch if it doesn't. And that's that when you go through a company's report and accounts, it's rather like a bikini. It reveals what's interesting but covers up what's crucial. So take that as you like, and if it works for you in terms of how you make your assessment and judgments, great. But I think we do a lot of work in that earning space in some of the more advanced strategies, as Mitch said, such as straddles, not something for cash flow on demand.
Great stuff. Okay, Rick, could you please stand up? Rick, we have in the room. Here he is. Give him a round of applause, guys. Gee whiz, we'll have to give Vanessa and Beck a round of applause later on for the nimble movement we've got around the room here. Cracking pace.
We might do a rapid fire when we wrap this up for another 5 minutes.
Running out of time. You'll be right. Okay, Rick, what was your question, my friend?
I've heard you mention a couple of times, including once this morning, some guy made $205,000 in a day. Just wanted to know how.
Good question, or?
That's good.
So what's the secret sauce is what we're really asking here.
I think the secret sauce, and I've spent an awful lot of time with that particular client, and when I say client, it's actually a husband and wife team. They're probably one of the best examples of a husband and wife really, really working together for a common purpose. And I think the secret sauce for them is absolute outright discipline. They're the most lovely people you'd meet. They're very down to earth. Neither of them particularly had high-paying careers when they were working. Many years ago, they set up a self-managed super, and time has worked nicely for them, so that amount has obviously grown over time. And the particular couple, I remember catching up with Stuart, who's one half of the duo, and we were talking about the approach and systems, and he actually uses an incredibly simple system. And simplicity is the ultimate in sophistication. So what he will do, and the way they work, Stuart does the analysis work, and then when they found a trade or trades that work for them, he'll write it up into the order book, and he passes it on to his wife, Jill. And the reason Jill looks after everything, from his point of view, he says, look, if something happens to me, my wife knows where everything is, so he likes that peace of mind. He's a very old school sort of guy, and very, very sort of structured sort of person. And it also disconnects him from the emotion of the trades, because Jill's happy to place the trades because they're instruction and orders, not her ego of, I found a good trade, I'm just following your instructions. So what that enables you to do is actually very easily place a trade without all the baggage of being the author of that trade. If I go back to my time in London as an institutional trader, we had a separate desk for processing orders that was not the person that was finding the trade, if that makes sense, and it splits that up church and state. The second thing, the simplicity of their process is that as the market moves up towards highs, they're constantly selling out of positions and reverting back to cash, and then setting up orders at much lower levels in the market for when the market rolls over to pick those orders up to go back on again. And I appreciate that sounds incredibly basic, but these guys have got that process nailed to the nth degree, as we mentioned earlier with their results. And it's also been a really consistent thing for them. Not over 1 or 2 years, they've happened to be backing up as one of our traders of the year this year. But this is something they've been doing for a couple of decades now. So they've really got that process finessed. What do they say, about 10, 15 minutes, maybe 20 minutes doing his analysis work in the morning. They'll have breakfast, chat over coffee. There's the order book for the day. Jill will get that underway. They're done. And that notion then when markets fall, where most people are panicking and going, oh, gee, do we sell? That's automatically buying these positions. They don't take them out going, oh, we better not buy them today in case it falls further. They're just starting to acquire stock at lower levels. Very, very smart. And they're benefiting from the natural long-term up bias in markets, and they're doing very well with it. And I might add, thoroughly lovely human beings. It's always a pleasure to spend time with them. And that's always reassuring when you see people that are deserving, kind and nice and extremely benevolent in terms of the charity work they do, also making a ton of money too.
Great stuff. Okay, Chris M. We've got a couple of Chris's in the room. Chris M, if you wouldn't mind standing up for us. Right in the middle, there we go. Give him a round of applause. We're out of time. Okay, what have we got, Chris?
Just refreshing my memory. Yeah, hi there. All right, Jess, I had a question about, it's probably a question that everyone's thought about at one stage or another. It's like, if you had all this money ready to invest, what would you do with it? So, say, for example, you got 30K for cash on demand. How many separate trades should you make? For example, like spreading your risk. So, how would you break down that 30K into different trades?
Very nice. Thanks, Chris. I would say with 30 grand, the idea is that you want enough meat on the bone to make it worth your while. But then again, you don't want too big a position where you're not diversified. And that comes back to the topic of over-diversifying and under-diversifying. With a cash flow on demand perspective, me personally, and this is by no means advice, it's just a general comment, 30 grand, you're probably looking realistically at 3 positions of 10 grand to make it worth your while, if not maybe even 2 positions of 15. With that as well, you would want to make sure that the trades that you have are ideally in different sectors of the market. So if you've got 3 trades, one's in banking, one's in energy, and one's in utilities, as an example, rather than all 3 of them being in energy, because, well, then you've got very little incentive to diversify if it's all in one sector, if that kind of makes sense. Anything to add, AB?
Again, I think that's where things like exchange-traded funds can be of a great benefit to you, because with one trade you also have a level of diversification that's inbuilt. And this, to an extent, is where a lot of our supervised strategies really tick goals for our investors that are going, look, I've a finite amount of funds. I'm not really sure how to divvy that up. I'll take a little bit on myself to see how it feels with the trading side and to build my confidence. And in the meantime, I'll park the balance with you guys to put into one of those strategies that within itself is quite diversified. So that's another way of approaching that too.
Okay, last and final question, because we are running out of time. Chris K, if you wouldn't mind standing up. Chris K. There we go, in the middle there. Give him a round of applause. Last and final question before our outro, and we have afternoon tea. What have you got for us, Chris?
So my question was, what have you been shown us today? Could that easily be automated, or do you feel there's still a level of emotion in trading?
It absolutely can be automated. We're going to talk a little bit later about supervised strategies, which is a situation where you guys can park a set amount of cash and then we can do the execution and supervision for you. The benefit of running strategies like supervised strategies, Chris, is that they're all very much so rules-based systematic approaches. So we talk about building a trading plan, for example, and for you guys that are going to be hands-on traders doing cash flow on demand, that's where we talk about fundamentals, technicals, and quants. The supervised strategies take an approach where if this happens, we do this. If that happens, we do this. And that's a way to ensure that there literally is zero emotion involved, because no matter what that trade goes on, if that criteria is hit. One thing you can look at doing the further you go down the line is having very, very strict rules and processes within your business plan or trading plan to try and make it as systematic as possible. Anything to add?
Yeah, I think the key thing is systemized. Everyone's got their own bandwidth that they've got to work on. If you work shift work and you fly in, fly out, for example, or if you've got a household like mine where there's an army of children, or if you're someone that travels extensively, so you're on a plane, you've got to mold the approach you take to your investing around your lifestyle. There's no one size fits all. And taking the time to step out and plan. One of the things that we provide everyone when they come on board, of course, is a money and investing journal. When times are tough, when things get busy, the first thing people throw out the window is planning, because they don't have time to plan because they need to do. In actual fact, you should reverse that and spend more time planning, because then you can prioritize and work through. The point I'm making, I guess, is I'll give you 2 examples. One of our clients, this was a gentleman by the name of Jason down in Melbourne, trades once a week for about 20 minutes a week. That's it. And it's on a Saturday morning at 6 a.m. And that's time he's carved out. And that's when he does his particular thing. And you might be curious to know what that thing is, but that's what he does. He does his thing. Let's call it that for the minute. And he's got that managed into that because he's got kids and he's got other demands on his time. And he likes that peace and quiet at 6 o'clock on a Saturday morning just to go bang, and it's done for the week. And there's no supervision with what he's doing because he just returns to it the following Saturday at 6 a.m. and picks it up. Now that's one very abstract side of the equation. If I look at the work the guys do in the office, they've got a very streamlined process, starting with our signal screener, which sets up our day, and then we look at obviously what the markets have done. And look, we're managing thousands of different positions across a whole raft of advanced strategies, plus cash flow on demand and other things in there. So we go through and screen, what are my positions doing? What do I need to do? And you can be as complex as that, as simple as that, or somewhere in the middle, but the more automated you make it, the better. I'll give you 3 takeaways, give you real value on this question because it's a great question. Number 1, make sure when you look at your account on IB, the first thing that does not come up is your account window, because if it shows a positive or negative, it's going to skew the way you look at the rest of your day. So start it on your watch list. Go through and look at the positions you know you're carrying, and you can see whether they're up or down. And over a period of time, you'll see how they interrelate to each other anyway. And that probably takes maybe a minute or 2. Bring up charts if you need to. And then finally, is there any action that's needed based on the charts? Am I selling calls today? Have I hit my stop? Whatever it might be. The last thing, just before you log off, is look at where your portfolio sits. Don't start with that.
Thank you very much.
Thank you very much.
We thought you'd enjoy seeing something live, and I guess something that I'll throw out to the audience with a live audience if we can. How many of you have earned or learned something from what we've done with you guys over the last little while? Give us a bit of feedback on that, make some noise, give us a show of hands, see where we are, all right? And I think this is really important in the cluttered world online, because there are so many people that host podcasts that it's just a scripted thing. You've seen us do one live here with you today. Hopefully we've given you some great value with that. So on that note, the key things I'd ask you to do, as always, don't just take notes, take plenty of action. Secondly, give us a review and a rating, and we'll look forward to hosting you next week.